All right then, welcome back to another episode of Caffeine Fueled Ventures. We've got, I think, a pretty exciting one for you guys today. It's completely different, brainchild of Sir Bullock over there. Essentially, what we're going to be doing today is sort of a stocks kind of episode, and I'm not going to kind of go into. I'm going to leave it to Jake to kind of go into how this is going to work. But this is going to be in a format that you might not have really seen before, but I think it's going to be a really fun one. Just straight off the bat, I want to make it clear that this is not investing or financial advice of any kind. This is just Jake and I having a bit of back and forth on something that we're both kind of interested in. I've not really done any intense research on this, and to be honest, my knowledge on stocks isn't quite at Jake's level. Jake is also not necessarily I wouldn't say a master either, I think you would be fair to say, right? But I think, between us, we kind of might be able to understand it a little bit. So, with that being said, I'm going to hand over to Jake to kind of walk us through how this is going to play out and how we're going to kind of talk about.
Thanks, man. Yeah, just to reiterate, I am not a savant in the stock space. There is no denying. I don't really know what I'm talking about either. But, nonetheless, it's something I think, as you say, we're both passionate about. So it's kind of a cool one to discuss. So we're going to be doing a stocks draft. I also, like Rory, haven't done a huge amount of research. We wanted this to be a bit more easygoing of an approach, a bit of a talk, a bit of a team building, shall we call it, building of our own stock team, essentially. So how it's going to work, as I say, we're going to be doing a draft, and that might be more familiar with the US audience, but for anyone in the UK or elsewhere that's not aware of what that is, essentially we will be picking stocks and taking it in turns. We will be using a snake format, which essentially means we're going to be going back and forth the way a snake would. It essentially enables each person to get to pick in the first round of a given draft round at least once, or in alternating rounds. It basically means you're going to get 2 picks at a time after that first pick. So when someone picks a stock, the way a draft works is that it means that stock is no longer available to the next team up. So if I pick a stock, it's not going to be available to Rory, and vice versa. Think picking football teams in a schoolyard. If you pick the best player, that best player isn't available to the next person up. And just to kind of give an example of what that snake round thing looks like, if I went first, Rory's going to go next. Rory then gets to go again, picking in the next round first, and then it's me. So just a clear caveat to the overall endeavor here today. We are going to be staying away from big tech style stocks. There's 2 reasons to this. The first one is we both work in big tech in our day jobs, and we want to avoid any form of conflict of interest. We also thought that, we wanted to make this draft a little unique, and 95% of, commentary out there has some sort of big tech aspect to it because they make up such a large stranglehold on the big indexes. One clarification there, though, is you could class anything as tech, I'm sure, if you really tried, but we're talking traditional big tech is what we're avoiding. So although not strictly headquartered in Silicon Valley, we're thinking of the companies that if you think of that company, you think Silicon Valley, aka big tech, and we'll be avoiding those. So don't come at us if you're like, oh, why isn't that company in there? They're a really good company. If they're big tech, that's why. So pipe it. I'm just telling our audience to pipe down, but never mind. Why not?
Nice.
All right. So,
but with that being said, please make sure you put comments in the comment field on YouTube.
Exactly. We'd like your comments, but if it's about a big tech stock, we're not talking about it. Cool. So we're going to be doing a 5-round draft. We thought that way we could cover a little bit of a diverse portfolio. We decided that, we're going to give each round of the draft a category to try and help make sure that portfolio has got a nice diverse array of shares. So round 1 is going to be a stock from the UK Stock Exchange, the London Stock Exchange. Round 2 is going to be from the US Stock Exchange, so the New York Stock Exchange. Round 3 is going to be a dividend stock, a stock that pays a dividend. Round 4, we decided to go a little bit left field here. So we're looking for a stock that is either in the energy, telecom, or a utility sector. So, gas, electric, that sort of stuff. And then round 5, we left that one open to be a wildcard style round for picking your favorite non-big tech stock. So we will be picking individual stocks only, or focusing on individual stocks instead of, index funds or anything like that, mutual funds. And the key reason being, we just thought that way you get a bit of a clearer comparison between my portfolio and Rory's portfolio that we're about to build here on the cuff. We will be tracking our progress in Excel. And if we can find a nice simple way of doing it, we might even use paper style accounts to purchase them in what would be fake money. For anyone that's not quite familiar with the paper term, you can essentially use, fake money to test a strategy. So if we get chance, we'll do that too. But for the short term, we'll be tracking in Excel. We will be purchasing all stocks at the market execution price. So for anyone that's not quite aware, that basically means at the end of this, we'll take the price and that will be the price of purchase instead of waiting around 3 weeks to find, the appropriate time to purchase the stock when the stock drops or whatever. No, we're going to be basically buying, there and then. We do plan to do a review and some occasional check back in episodes on how our performance is going. But in order to try and make this a fun and effective competition between myself and Rory, the aim of the endeavor is to have the biggest return within a 1-year period. So we are recording towards the end of August in 2021. And at the end of August in 2022, when we'll take our snapshot and see whose portfolio has performed better. And obviously, if we're going to do that, in order to drive some consistency, once we've completed all of our rounds of picking stocks, we're going to go through and do an asset allocation, which will just be how many shares of each you're going to purchase. And we're going to base that on a portfolio of £2,000. That's Great British pounds, which is around $2,700 for anyone that's not quite working in the GBP terminology. So we're going to decide who goes first as the brainchild of craziness, I suppose. I will be doing the coin flipping. We are using a standard 10p piece over here in the UK. So Rory, would you like heads or tails as the guest into the episode?
Ooh. Always heads, mate.
Okay, so just you won't be able to see this on screen because I'm not that skilled, but I'm just going to let it hit the desk in front of me. Okay.
Cool.
Oh, and it was tails. And I can't. Oh, hang on. I can't show you. I've got a camera that moves.
Nah, we're good.
There it is. There it is. You've got to zoom in if you want to see it, but there it is. It is there. All right, camera's back up and running. All right, so tails, I go first, but in many ways, Rory, that sets you up as you get to go first in round 2 after your round 1 pick. So if there's no further ado, let's get cracking if you're cool with that.
Yeah, let's do it.
All right, dude, so round 1, something from the UK Stock Exchange. I'm going to come out in what I wasn't sure about, but I'm coming out with the stock IAG.L, okay? And .L, just 9 times out of 10 is clarifying it's on the London Stock Exchange. But IAG is essentially I'm going to get the terminology right, but, It's the International Consolidated Airline Group. Okay, so the reason I wanted to go for this one, right? This one here is a group of essentially airlines. They've got 50,000 employees, and the subsidiaries that sit with in this portfolio of a business, they focus on the transportation of passengers and cargo across UK, Spain, Ireland, US, and the rest of the world. But the brands that fall under this beauty, in my opinion, or not in my opinion, as a fact, sorry, are BA, Iberia, Vueling, Aer Lingus, and Level Brands. They have a fleet of 533 aircraft, and they fly to 279 destinations across those entire airlines. So, a lot of numbers thrown at you, but essentially here, I am purchasing, with my first pick in the draft, the International Consolidated Airline Group, and the primary reason being airline stocks have taken a heavy hit during COVID. And I think as we start to see that bounce back, the airline stocks are going to spring back. Now, admittedly, that might take longer than a year, but I'm going all in and saying, yes, within the year, we're going to see some good returns. The stock price at the moment is £1.68. That's the other beauty with this one, right? The stock is a nice cheap stock, so I'm going to be able to buy a good number of shares. And we have seen historical highs of around £4.70. So, and that was in the year or so before COVID hit. So there is definite runway on this stock. That's going to be enough of my explanation, but there you go, dude. That's my first pick. If you've got any thoughts, feel free to fire them back.
Yeah, for sure. So really interesting one. When I heard you say IAG, I was like, oh, here we go. So this is why Jake's decided to defer his booking of tickets for my wedding recently, because what he's clearly wanted to do is boost their profits just as he chooses it for his first round in his UK stock. Brilliant choice, man. I completely agree with you. I mean, they've taken an absolute dive, and they will, just based on how consumer habits are, like we all like to go on holidays, we all will go back on holidays, and there's going to be a load of pent up demand. Now, brave choice, thinking that pent up demand might roll out within the year. But I do like it. It's brazen.
Yeah, and the thing is, dude, right? Like, I'm not as well into the numbers as I could be, but it's 35% down on its two-year high, and it's 26% down over the last 6 months. Like, I reckon we can at least recover that 26% from 6 months ago. When things were easing up. So yeah, You're right. I've gone brazen, and obviously the only reason I'm holding off booking tickets to your wedding is because I wanted my extra money in the P&L, right? That's what it's all about.
Oh, I love that, man. Yeah, absolutely. Yeah, I know that. This is going to show a stark contrast to the way that we've done our analysis.
Okay.
So I haven't, for the stocks I have down here, and I'm going to show you how I've got them down in a second, I haven't even looked at the stock price. So they could be at an all-time high and they're about to go down. I'm basing all of my choices off of the rationale of just like what's happening kind of, in current affairs, I think. So it'll be really interesting to see how that plays out. Just mentioning how I've got them down, I won't show my phone screen, but I've got it on my very old iPhone that I've got here, where I've been in my notes throughout the week. I just sort of like jotting in when I thought, I thought of an idea. And I'm hoping that it lasts on us, because I don't often, and I've been on it a little bit today, and although I could just plug it in, but it's just more fun to see whether or not it's going to die. My phone does typically die within about half a day if I use it quite a bit now. So I need a new iPhone. I
love this, dude. We've got our own sub-story on the go. Will the phone last?
We'll see. If it doesn't, I'm going to be doing this off of memory, and as you know,
great.
My memory is shocking. So this is not going to be good. Are you ready?
I am, dude. And I just so you know, I'm going to be taking the notes for the audience out. I'm going to be taking notes of the picks, and then that way we can do our asset allocation at the end. But also, as Rory gives me the ticker, we might be able to pull in some of the numbers around current stock price, etc. Should we find those interesting? But yeah, dude, take it away.
Sweet. All right. So I am going for, on the London Stock Exchange, Kingfisher. Do you know who they are?
I've got an idea, but go on, hit me with your.
Cool. So, what I believe they are, they own, well, they're the header company for a few brands, but they own probably most notably B&Q, among some others. So, and I always thought B&Q was owned by Sainsbury's, so that's actually its home base that it is when I kind of Googled it to just double check that was correct. So, among other kind of what I would describe as kind of consumer home improvement kind of brands, I would say. So where, for those of you that are joining us from other countries, please bear with us because we are going to talk about some more global, I guess, stocks when we come to the US stocks. You might be more recognizable. But Kingfisher, for those of you outside of the UK and also those that are like me and didn't know what Kingfisher was, I was looking for a brand that kind of went with my brainwave of thinking we are and have been trapped in our homes for some time, for a little while, and a lot of people have been doing home improvements. I think that trend is going to continue, especially through the winter, based on the fact that a lot of companies haven't quite returned to the office yet, and actually some are going to just never return to the office or only return on a part-time basis. So I think there is a lot of goodness still yet to come from people doing home improvement. So yeah, that's kind of where I'm at. It's a fully shot in the dark. I don't even know what Kingfisher's stock price is, or whether it's up, down, left, right, but they're one of the biggest kind of UK home improvement kind of header brands. So that's where I like
it, right? So I just quickly jumped on and had a little look. So not only do they own B&Q, they own Screwfix and TradePoint, which, B&Q, obviously that's consumer retail more than it is anything else, but Screwfix plays to both the consumer and the industry itself, right? So yeah, they've got just shy of 1,400 stores in 8 countries, according to this, right across Europe. So, mate, nice choice. It is got a high stock price, but that's not, stock price is not necessarily a huge thing, really. Stock price currently sits at around £354, I believe. Let me just check I've got that right, and that's not, that's pounds, not pennies. And all in, looking at this, they are around 29% up year on year and 83% up over on a 2-year scale. So, yeah, if that trend continues, dude, I think you're in for a winner here. So, nice choice. That obviously brings us to the close of round 1. So we had International Airline Group, and we've just had Kingfisher from Mr. Orchard. So Mr. Orchard gets to go again. So take us away, dude, with your first pick in the second round. We are now on to the US Stock Exchange. So New York Stock Exchange, everyone.
Brilliant. All right. I had a couple down for this, and I'm going to make my choice now. Cool. All right. Serious. The stock that I'm going to choose is called QuantumScape. I thought it was Scope. It's not. QuantumScape. They're actually a relatively new stock, as far as I'm aware, derived from a battery startup. So I've recently been thinking a lot about electric cars, having recently bought a hybrid car. And in the UK, certainly, and I know these different kind of rules and stuff have been being inherited around the globe, but in the UK, certainly, we have a goal of having no vehicle being sold to the UK, new vehicle being sold to the UK that isn't fully electric by 2030. Do I think that we can hit that goal? No, I don't think so. Based on the infrastructure that we currently have for electric vehicles, it's pretty dire. Luckily, mine is a hybrid and I don't actually need to charge it in places. But where I've tried to, my experience has been less than satisfactory, to say the least. So I don't think that we'll get there. But the big push for electric vehicles, I think, is fueling the need to find better battery technologies. Obviously, you've got the big ones like Tesla, etc. And I was taking a look. One of the reasons I couldn't include them was because they are floated on the, I want to say, Japanese stock exchange, but that I was looking at Samsung because they actually have a huge. They've actually just recently got the contract for Tesla for another year for producing their batteries, and also are committed to providing is it Cobalt free batteries. So essentially, that's gonna, when we actually get to that point, it's gonna really reduce the cost of batteries because it's one of those rare earth materials that costs a lot of money. Anyway, battery technologies, not just for the car thing, that's what got me thinking about it, but batteries in absolutely everything. We've recently spoken on one of our news podcasts recently about this kind of influx in electric scooters that we're seeing sort of everywhere. And I think battery technology is one of those things that's really going to carry us forwards. I think that these guys are really looking at traditional lithium-ion batteries and the technology associated with that. I could have gone for something, one of those kind of off-the-cuff where they are looking at completely new battery technologies. And I actually had some stock for a company that I purchased a long time ago, actually, that was looking at a completely new, radical way of, creating battery technologies. However, I kind of thought to myself, I doubt that's going to come into any kind of light in the next year. So I'm going to go for a more traditional one. Any thoughts on that, mate?
I like it. So one of the newer companies probably on our selection in the grand scheme of things, only around since 2010. And for anyone that thinks I just have this fact in my head, I don't. I'm using Yahoo Finance. It's pretty straightforward. They have a profile tab. So they've been around since 2010. Yeah, man, I quite like it, right? So you're right. Battery technology is so important, right? With everything going on, especially when you talk about car, the overall world view on bringing EV vehicles to the mainstream, I suppose. You're right. Yours is quite a different one. You're quite lucky with yours. Yours isn't necessarily quite as juicy as perhaps some cars in regards to battery drain. But yeah, I like this, dude, because if you look at it, overall, $21-ish is the current price on this bad boy. We have a range that is significant. So, just in the last 52 weeks alone, there is a lot of up and down within this stock. We have as low as $10 and as high as $140. So there is a lot of room for this stock to move. Now, without getting too deep into it, I'm just looking at the overall, and I like that. That's, there is reason for this stock to move. So, yeah, I like it. Good choice, I think.
Nice. I mean, I probably could have done with about 2 seconds of Googling, finding out what the stock price was for each of my choices. But I thought, you know what? I'll let Jake do it live on the episode.
Yeah, mate, I'm just winging it. So it's apologies at home if you're not overly enjoying my winged approach here. But yes, I like it. And all in, they are down on the year, which isn't necessarily surprising, right? Car sales, I think, I would guess as a whole are down, given people are stuck at home.
Well, interestingly, I don't know about cars, so new cars as a whole, but the used car market has gone bananas. Mainly, I think, due to short supply of cars, new cars in the market. And I think as a whole, used cars have increased. It was something like in the UK, 25% the prices during the beginning of the pandemic. But I don't. New cars, I'm not too sure.
No.
Sorry, that was just a little
makes complete
side.
sense, right? So if there's a squeeze on the used car market for two reasons, first being, well, there's a a lack of supply in some of the new car market. Well, if factories were shut during the initial period of COVID, they're still catching up, so that makes sense. And then you've got the fact that ultimately, if people aren't going anywhere, then you've also got how many people are buying a brand new car? They're not necessarily doing that commute they used to do. So we might be a little way off before we see a real rise in the car market again. And if that's the case, the fact that the stock's down, a good volume this year, I think. So in the last 6 months, it's down 65% roughly, according to this, which I don't think is a concern. So, mate, yeah, love this. Good choice. All right, I'm gonna hit you with my next one now. So I got to be honest, I've made. I don't know if you could argue I've cheated here. I don't know, but I'm coming out the gates with a stock that I've actually been involved in with for a little while. So I'm going for Berkshire Hathaway. That's the bad boy I'm purchasing. So for those that aren't familiar, Berkshire Hathaway is actually Warren Buffett's company. Mr. Investing Genius himself. So the reason I say this might be slightly cheating is because Berkshire Hathaway is essentially a fund company. They have an index. They manage that fund, and the performance of that fund directly correlates, or has some correlation to their overall stock price, right? So they're not necessarily selling retail goods, I suppose, like most others. They're selling an investment option, or selling a fund that people invest in. Amount of money invested and performance, etc., is what's going to drive their stock price. The reason I like this little one here is because although it has a slightly higher stock price than most of my other choices, it does obviously have the genius himself, that is Mr. Buffett, at the helm. So all in, I'm liking the management team. We also have the fact that during COVID, they did take a hit. By picking it now, I'm probably getting in at the higher end of what would be the COVID recovery, shall we call it. So I'm getting in at perhaps pre-COVID prices. But all in, I think because of the way they're managed, because of the way investments are going forward at the moment, I think we're going to see this stock continue to rise. Now, I may have screwed myself in the competition here, in that I've chosen a stock that I think is unbelievably a good choice in the long term. The 1 year turnaround on this bad boy might not necessarily do my chances in this competition too great, but 10 years from now, I reckon this bad boy is cruising. So that's just my view. But yeah, there you go, dude. Maybe I've cheated.
That's an interesting one, man. No, I think that's cool. It's good. That's a good one. I think it's good to bring people's attention to these ones. I've never even heard of it before. Obviously, heard of Warren Buffett, and I think a lot of his kind of quotes are always about time, aren't they? So it'll be quite an interesting one to see if it recovers in time for you. But we'll see, man. No, it sounds like a good one.
Yeah, they're 42% up over the last 2 years, but over the last year they're also 35% up. Which, when you consider that, last year would have been the COVID bubble, that's tough. So yeah, it's going to be an interesting one. I definitely think time, if we were playing the super long game, might be on my favour with this one, but the 1 year turnaround might be a squeeze. So yes. So I've gone Berkshire Hathaway for pick number 2. I'm just going to pencil that in. And we move on to round 3, which is going to be a dividend stock. So a dividend stock, obviously, for those that know, bear with us. For those that don't, essentially it's a stock that's going to be paying out its shareholders a percentage or a portion of the profits. Essentially, it's going to be every quarter or every 6 months, depending on how they pay. You could be getting, or once a year even, actually, you could essentially receive a check or a payment from that business as a way of thanking you for being a shareholder, because they take your money and use that as an investment into whatever they want to do, grow the business, move into a new sector, whatever. So they reward you via dividends. So a company has to be paying dividends for it to qualify for this round. And once again, I wouldn't say I've cheated, but I've probably gone with the obvious one here. I've gone for a classic dividend king is what I'm going for. And I was torn, actually. And Rory's shaking his head. He already might know who I'm choosing. But my dividend king that I am throwing down onto the mat in round 3 is Coca-Cola. So I've kept it super simple, and maybe I've screwed Rory if he's chosen Coca-Cola and he's now going to scramble. But yeah, this one was an interesting one, right, for me, because I thought, well, the soft drink industry is something as a whole that we are in a good position. I could have chosen PepsiCo to be clear. Both companies do pay dividends. I chose Coca-Cola for 2 reasons. They are a dividend king, and basically that means they've paid dividends for the last 50 years, so there's a clear track record there. Also, their stock price is around the $50 mark, whereas PepsiCo's is around 160. Now, just because the stock price is lower, to be clear, does not necessarily mean it's a better investment, because that just might mean there's more shares out there. But the reason I like Coca-Cola is because it took a real steep dive at the beginning of COVID, where pubs, clubs, etc. were shut and people weren't out. And if people aren't out, they're not buying Coca-Cola off of convenience stores or off the train station platforms, etc. So sales took a dive, right? We got down all the way down to $40. We have seen a recovery. We're now back up at around 56-ish, which is just around the pre-COVID, maybe a little higher than the pre-COVID bubble. But this is a stock we have seen grow essentially year after year. Plus, they've been able to pay dividends. And the reason I actually liked this one was because if you put them in, and it's not necessarily always the best measure, but if you look at their earnings per share, for those that are maybe into the numbers, their earnings per share is just sub $2 per share. And the reason I like that is because, some companies are, in the negatives. Other companies are absolutely going bonkers. But for those companies within the, the soft drink space, just under 2 is not bad. Now, PepsiCo does have a better earnings per share, but for me, I don't think you can argue with Coca-Cola.
That's a good one, man. It's funny. I was going to say, as soon as you started going through that one, I was like, right, then I'm going Pepsi. No, it's a really good one. Maybe actually you could explain for me, or let me tell you where my simplistic mind kind of went with that earnings per share kind of bit that you went through just there. I assume it's good to, when you're talking about dividends, it's really important to have a good earnings per share ratio, because, of course, if you have a lot of shares and not much earnings per those shares, then you're not going to have much profits to divide out to those dividends. So you kind of need like a really good ratio on that, I'm assuming.
I think ultimately, although earnings per share is a helpful one, the one that perhaps is more useful is the PE ratio. And the PE ratio is essentially the price to earnings ratio. So how much more is the price versus your actual earnings? And the reason that's important is because you're going to have a situation where if a company has a high price to earnings ratio, then essentially it means they're over leveraged. Is probably the simplest way to describe it. And that changes with the market. I've actually been reading the Common Sense Investing book by John Bogle, and one thing he talks about is back in, say, the 90s, the average PE ratio was around 7. So 7 times your price was worth 7 times your actual total earnings for a year. However, given the way the markets have changed, the average is much closer to 25 now. So, companies have been allowed, or their prices have been allowed to climb whilst their earnings haven't necessarily grown in the same percentage. It's essentially what that says. The reason I went for Coca-Cola over Pepsi, and let's be clear, Pepsi do actually have, as I say, a better EPS. They have nearer to 6. I just like Coca-Cola as a whole because if you kind of look at the the overall trajectory, they have been on a pretty steady climb over the last 5 years. You know, the stock price back in 2016 was around $42. They climbed up quite nicely all the way through to the beginning of COVID, and then they took their dive at the beginning of COVID. And only now are they starting to get that recovery from COVID. For me, I just think it's one of the safest ones I could add to the portfolio. Essentially, that was why I chose Coca-Cola.
Nice. No, I like it, man. I mean, they've been around for a while. They're going to be around for a while to come. So yeah, good choice.
Go on, dude.
All right,
take us away. What are you going with?
Cool. All right. So what I have, and by the way, when I was researching this, obviously I didn't know off the top of my head, decent dividend stocks. So I Googled it. I went to one of the first websites I came across, a list of 100, I think it was, or whatever, scanned down the list and tried to just pull out a company that I thought looked interesting to me. So the company that I have gone with, and you can tell me actually that maybe they are no good from a dividend perspective, is Direct Line. So, for those of you that do not know, Direct Line is an insurance company here in the UK. They are part of the Royal Bank of Scotland header company. I believe they are still kind of indexed separately from that. And the reason that I've gone with an insurance company, and one that we typically here in the UK associate with home, and then but also quite more importantly automotive insurance, is that I think that an insurance company, well, I don't think, this is how an insurance company makes their money. They balance risk and try to make money off the back of that. One thing that car insurance companies have seen over the past year or so is actually people had bought car insurance thinking that they were going to be doing a commute, and then not having done that commute means that actually accidents and things like that are happening at a lower rate. What's kind of interesting about that, I think, is that I think that's probably set to continue. I think people are going to either have purchased insurance thinking that they were going back to the office, sometime soon, and actually it's transpired that they won't, or actually they're just going to drive around a lot less than they did. Now, having said that, I do also realise that a lot of companies have also paid back their insurees. Is that the right? The people that bought their insurance products, they've actually paid them back, some of that money. I know, I'm pretty sure Direct Line was one of those companies that kind of said, hey, actually we've had less accidents this year, so your premium has been reduced and here's some money back. But I just think it's a really interesting space to be in. So I think, there's some opportunity for goodness there. And with that goodness, hopefully some decent dividend yields.
Mate, it's a great choice, right? So this one actually does have a really strong dividend yield. Currently, it's sitting around 7.5%, or 7.23% dividend yield, which is pretty strong. And I have had a little look, and the latest one was 7.2 back in August, but back in April, I actually paid a 14% dividend yield. So very high dividend yield all in, which, mate, really good in that regard. Their stock price is high, $311, but I don't think that or £311, sorry, but I don't think that should necessarily deter anyone. I quite like this, and I think you're right. People are going to be driving more as well when COVID kind of eases up and people are more back in the office, and obviously that might mean more people with cars, etc., are having to pay insurance premiums, and I think you're right. Direct Line was one of those companies that did give money back. I was with Direct Line, so yeah, mate, I like it. Good choice.
Cool. All right, mate.
So we move on to round 4: energy, telecom, and utility. Take us away, dude. You're up first.
Cool. All right. I'm going to go for a well, I don't know. I guess you can split them across a telecom or a utility. A company that I just think is really interesting, given we're based in the UK, and they're a huge company for us. So I'm going to go with Vodafone. So the reason that I'm going to go with Vodafone is, one, because they're a huge UK-based company. So I think that's obviously makes them really interesting. But also because I think, and you can see that my predictions are following a very certain kind of theme of working from home or pandemic related or whatever. But I think that is probably I don't know. Tell me if I'm wrong, but that's probably the barometer or the thing that's making the most movement in the stock market at the moment in terms of current affairs news. So that's kind of where I'm at. So I'm going with Vodafone because actually I use them for my broadband. I'm also with Vodafone, for my cellular. For those of you that are with us from the US, or just my mobile contract if you're with us from the UK. And I think that with more and more people working from home, I think that people are going to start to get more and more reimbursements for their broadband from the company they work with, especially as it starts to become more built into their contract that they work from home as opposed to just working from home as a result of the pandemic. So I think that people are potentially going to try and opt for maybe slightly more expensive broadband. I see them as being one of the more premium providers in our in the UK. No, certainly not the most premium. I think that would probably be something like Sky or even Virgin Media. I think do a broadband. I think they're probably considered the most premium, but I think that Vodafone is considered quite good. So that's where I'm going with it. And don't get me wrong, I think it's a hugely what's the right word? It's a hugely inundated market. Like there's a lot of competition there. So, maybe actually they'll lose out to someone else with better marketing. But yeah, that's just where I'm at. So I'm thinking Vodafone for mine. It's a wild card.
Mate, another good choice. So, at the end of the day, I think you're right. They're not necessarily the premium in the broadband space. As an example, I think you're probably right. It's probably Virgin Media as a result of the fact that there's this fiber optic cable and a very selective number of places you can actually get Virgin. So, not everybody has access to it. All in, you've actually managed to bag an additional dividend stock here, which will help your overall performance. According to Yahoo, 6.25% is their average yield. From what I could see, they paid around 4.8% back in June. So, yearly dividend yield of 6.25%. If you can add that to your portfolio, that's an even better win on top of the fact, you've got a stock that, ultimately could grow. In the overall year-long term, I would argue they are, they're not exactly booming over the last 5 years, over the last year, sorry. So they're back around where they were this time last year. So it's not like they've taken a tank or boomed. The overall 5-year trend, not necessarily great looking, but, they used to be worth around 225 quid. Ballpark, we're now down at around 125. But if I kind of go back to the pre-COVID bubble, which is kind of where I've tried to put the barometer for things, you've definitely got, runway to get back up to prices of around 150, right? So,
Perfect.
you won't necessarily recover the 250 or the 225 back from December 2017. But I think there's runway, as you say, to get back up to that pre-COVID price because, my opinion is the pre-COVID price is kind of the barometer of where you can expect, I would say, some or most stocks to return to at some point. So, mate, I like it. You've got potentially a £25 runway in that stock, and your risk is only another 25 quid either way. So it's a good good choice there. All right, so round 4, you hit us with Vodafone. Realizing we're running long, so I'm going to smash through this next one. got to be honest, this was a tough one. I was quite torn. I wrote down a couple of different examples. I included examples like MPC, which is essentially a oil petroleum style company. I had Verizon down as a telecom company. I had AT&T as another telecom company. And man, I got to be honest, if we weren't running out of time, I might take some time to think about it. But as a company that I'm going to try and match your Vodafone, as you've been able to throw an additional dividend stock in there, I'm going to throw T, as in AT&T, as my choice. And the reason being is I know they have a strong dividend yield. I honestly, probably before this call, was heading towards MPC, which MPC is a company that focuses in oil production and the use of oil, etc. But given that you've already driven us, cleaner energy stance, I'm going to stick away from the Uber petroleum style of life. And I'm going with AT&T, another telecom provider, primarily based out of the US. But their dividend yield's good. The stock price sits at around $28. They are down so far this year, so I'm hoping we will see some corrections towards that, and we'll get back up. But yeah, I'm gonna throw AT&T in the mix.
Love it. Yeah, man. I mean, what can I say? I'm setting a trend for this one, aren't I? So, yeah, I mean, it's another solid choice, I imagine. Given being a US, right? They're a US stock, right? Yeah. So obviously, I think similar to the sentiment that I was providing for my choice for Vodafone, I think the same applies for AT&T, right? I think people working from home, more demand on the network. So yeah.
There's a bold
choice,
one,
mate.
right? Because their 2-year trend actually has them down 21%. So you could argue this is a company heading to zero. So I've taken a brazen choice. I'm going to ride this dividend yield whilst I can. And if we were playing the super long term in the counterpoint to my Berkshire Hathaway, if we were playing the super long term, I might not go with this one. But within a year, I think we can see some recovery. The price is low at the moment, and I'm going to take it. So we move on to the wild card round.
Love it.
And I'm going to hit you with a pretty straightforward one. This is a company that I've actually been following since, around September or August last year. I've been fortunate enough to ride some of the wave of this stock. It is floated on the New York Stock Exchange, and it is NIO. No, not Neo as in from the Matrix. Neo is in NIO. They are a car manufacturer based out of China, and I have no better description for this stock other than the way it is described within free trade, and that is Chinese Tesla. They are a business that focuses on EV vehicles. They have a very different approach to the battery or charging system, from my understanding. Instead of charging the battery, they will be providing outlets, or we'll call them mini garages, that you can just drive into like you would a car wash, and it will replace the battery for you. So you don't charge the battery is essentially replaced at a charging point. That's the focus of their technology. I think it's an interesting and different take to Tesla, but for me, we're down at around the $37 mark on this bad boy, and I think we could easily run it to 100 over the next couple of years. So yeah, let's wait and see.
Mate, that's an interesting choice. I was just thinking to myself as you were talking then, I don't think either of us has slated the other person's choice yet, so I wanted to
go for it.
I wanted to do that with this one, but unfortunately I don't think I can, because no, I can't. I think it's a brilliant choice. That's an interesting take on the challenges of charging cars. One of the things that, I go back to it, like the challenges that I've had with charging my car, for example, when I've been out and about, and to be honest, just doing it out of purely messing around, to be honest, rather than actually needing to charge the car. Like I said, it's got a combustion engine in it as well, but is that the infrastructure for charging is just so difficult. I understand the challenges. Like, you have to be connected in order to charge a car with the battery in the car, right? you have to be connected, tethered to a charging point of whatever that might be for a considerable period of time. Regardless if you could use one of those superchargers from Tesla, and I think, you can get a decent enough charge in an hour, I think it is, to get you like a decent enough way, or maybe it's 20 minutes. Regardless, that is a lot longer than it takes you to pull up to a petrol station, and in an emergency situation, say you need to do it really quickly, put a $5 of fuel in the tank, pay at the pump style, and then go and then drive again. You could do that in a few seconds. I would, maybe a minute, versus. So there's a big difference, and I think that's what causes a lot of the issues that we're kind of seeing. And I think this is a really genius take. So rather than charging the battery, you just swap the battery out. Yeah, I mean, it's simple but genius. I like it. And the one thing this one makes it a little risky, though, is it's although it's on the US stock exchange, it is a Chinese company, and the regulation around China can make for the financial conduct of those businesses to be quite tricky. So I think we're going to ride a lot of ups and downs with this one, and I'm prepared for that. But yeah, go on, dude. Hit me with your final one. Nice, mate. I like it a lot. So my final one, and I'm sort of scrolling around on my list, and I've still got battery, guys. We're at 70%, so we're doing good. I'm going to go with Philip Morris. Another UK. I've got quite a lot of UK stocks. Maybe we should have balanced it out a little bit. I've got a lot of UK stocks. Yeah, I'm feeling very nationalistic. I must be today. That's not normally in my nature. So. Philip Morris. Do you know who Philip Morris is?
I'm
assuming you do.
So educate me.
Ah. Okay. So Philip Morris is actually a tobacco brand. They own the brand Marlboro.
Oh.
What a stupid choice, you might say. Why would somebody choose a tobacco brand in this day and age? Like, who still smokes, for a first thing? And secondly, they're pretty much considered, they're pretty much ousted when it comes to, I forget what you call them, those kind of like groups of stocks, like hedge funds or whatever it might be, just because it's kind of, it's on that sort of very right wing, I guess, of stocks that you could choose. The reason I choose them is because recently for Philip Morris, and the only reason I even heard who they were was when they tried to takeover bid to purchase the company that actually makes inhalers for the UK, and actually I think for a large portion of worldwide, and I forget what that company is, and it's a side note, so I don't think it matters too much, but they were trying to do a hostile takeover and purchase essentially the shares at a considerably higher price than others that were vying to kind of take over the company. And it's a really interesting one, because why would a tobacco firm want to take over a company that is promoting or is a medical company for people with respiratory issues, shall I put it like that? And I think that's really interesting, because I think that Philip Morris then maybe is trying to rebrand themselves. Maybe they've seen the issues that, I think that they've been flying in their face for a very, very long time, right? Big tobacco, or whatever you might want to call it. It's, no longer do people think that it's healthy to smoke, and haven't done for many, many, many years. So you'd imagine they'd be on a downward trajectory. So, like I say, I've not even looked at the stock price. It could be up, it could be down, it could be going around. But what I think is that they are doing some stuff to try and rebrand themselves, or try and find some growth areas. So I thought maybe if they continue this over the next year, I might see some goodness from it. So again, WILDCARD, I think all of mine have been another UK company, but yeah, I'd love to know your thoughts, mate.
So I'm going to pull the microphone towards me, because the cat's currently coming in and harassed my my area here.
Well, for a second I thought you were picking up a fluffy hat. I obviously know that Jake has a cat, but it just didn't occur to me in that moment, and I was just like, oh, that's interesting. Like, he's obviously invested in a very fluffy hat.
He's come and harassed the middle of the episode, but never mind. Man, this is an interesting one. So
Love
price sits around £100, $100. Sorry, let me clarify. They're trending pretty strong over the last couple of years, or the last year or two. Looking at their profile, not only are they trying to rebrand and buy that new company, as you mentioned, that does the inhalers. The interesting thing here is they're listed as a consumer defense company or defensive company, which I thought was an interesting take. But from what I've read here, they not only sell and manufacture cigarettes, they sell other nicotine-containing products, smoke-free products, and related e-devices and accessories. So it sounds like they're not sticking, I know this, they own Marlboro and stuff. It doesn't sound like they are sticking exclusively to Marlboro. They also look to I'm assuming, they've got other cigarette brands here. They've got, I would assume, e-cigarette brands that you wouldn't know are theirs. So yeah, I think e-cigarettes are probably the way forward. Someone can get their nicotine requirements, and they not necessarily have to do all the the bad stuff that comes with actual cigarettes. So yeah, interesting choice. We got runway up to around $120. From what I can see, which was the 4-year high, sorry. So, yeah, it's an interesting one. It's a bold one. Let me be clear. This is probably the boldest one we've got in our selection. So I think this is going to be an intriguer. And all I'll say on that one, dude, is good luck.
Thank you very much, mate. Yeah, I think in a minute when we come to, and I don't know how we're going to do this, but delegate our £2,000, which is whatever that is, like $2,500, something like that, across these stocks. I might not do $2,700. Nice. I might not put too much on that one, but I'm seeing here that we have run a little long. So what we might want to do is do the kind of allocating in a rapid way.
Yes.
Somehow.
So we'll try to move quick. Essentially, what I've got here is I've got a formula that normalizes the stock price to be pounds, irrelevant. Assuming most are on the UK stock exchange, but I'll need to go through and check because a fair number of yours were on the normal stock exchange, so the UK stock exchange, sorry, so there would be no need for normalization. But yeah, essentially we'll go through, just going to try and do that very quickly now. And I'm just tidying up. That was a London one. That was a London one. Mate, you getting a lot of London ones here is confusing my formulas, but I'll allow. And then yeah, essentially we are in a situation where 355.50, and you can essentially we can start with your portfolio if you like, so that we can go from there. But yeah, you've basically got 5 stocks. You're going to tell me the number of shares. I'll tell you the total cost, and then we need to just squeeze the number down slightly so that we can get it under that 2,000 mark. So you've got a lot of high stocks. So if we had more money, you might be flying. But I'm going to quickly fly through. So Kingfisher is around £335. You've got QS, which is £15. Ish. You've got Direct Line, which is 312 quid. You've got Vodafone, which is 123 pounds, and you've got Philip Morris, which is 73 quid.
Okay, all right. So I always thought that Vodafone was closer to £1.23. So I obviously have gotten my maths way off. So I might have to have a few less of those than I thought I was going to have. We'll go with that.
It's a good learning, though. It's a good learning,
cool.
right?
Okay.
So just to clarify, it's 123 quid because the stock is displayed in GBP. You would be referring to GBX, which is thousands of pennies, is essentially the way that does. Good learning, though.
Gotcha. Makes a lot of sense. Okay, so Kingfisher, I'd like to take 2 of those.
Okay.
I would like to take one of my direct lines.
One direct line, yep. Okay, you're around the £1,000 mark at this point.
I'd like to take one Philip Morris.
Okay. Yep.
And then I would like to take one of the Vodafones.
Okay, yep. That leaves you around 800 quid, just shy of 800.
Okay, and then stick the rest on QuantumScape.
All right, so that's going to give you... Oh, hang on, go back up. going to go. That's going to give you. That's going to give you around 50 shares of QuantumScape. So that comes in at a total of £1,996.35. All in. We'll keep the difference. We'll just put that as cash within the balance, so you don't need to worry about trying to spend that.
That's fine. You can PayPal me that, mate.
All right, cool. So, good job, man. That gives you a total of 55 shares across the different companies. I'm going a little radical. So I'm going to go, I'm just going to fly them out. And then what I'll do is I'll constrain it as needed. So I'm going to keep it simple. I'm going 4 shares of Berkshire Hathaway. I'm going 15 shares of Coca-Cola. I'm going, 10 shares of AT&T for now. Neo, I want another 20 shares. And I'm way over budget already, so I'll tidy this up in a second. And then I'm going 150 shares of IAG. All right, cool. So I have spent 2,500 quid thus far, so I'm going to constrain this down. And I'm going to take 5 shares of AT&T instead. And I'm going to cut down my Neo purchase to 15. And I'm still way over budget, so I'm going to go down to 10 on Coca-Cola. And now I've got 130 quid that I need to lose. So I guess I'm going to cut that down, and I get to increase one of these. So let me take 11 of those and 16 of those. No, 17.
As our audience can tell, we are doing this off the cuff, which I think is great, because I'm really excited for in a year's time. When we have 2 million subscribers, I'm really excited to do the kind of where we're at video. I think that's going to be a really good or podcast, obviously, depending on what platform you're listening to us on.
So mine are allocated. I've got myself under the £2,000 mark. I've got in at £1,997.81 pennies. I've got 153 shares of IAG, 3 shares of Berkshire Hathaway, 11 shares of Coca-Cola, 5 shares of AT&T, and 16 shares of Neo. There you go, dude. We have run long, so I'd suggest we round the episode up here, and if we want to talk afterwards, we can chat.
Love it. Perfect. All right. Well, I think that's been an awesome episode. I love that little brainchild of Jake's, and I think that's worked out pretty well. I hope you guys would agree with us. And obviously, I imagine the bit that you guys will be interested in is kind of working out what we do or what happens with our portfolios in a year's time. So, the best way to know what's going to be going on there is to like and subscribe to us and get those notifications. So, a year from now, when we're all on our holiday, having flown with British Airways, so Jake's stock price goes up, we can all come back and look how well we did. So I think we'll probably leave it there, mate. As I've already mentioned, please follow or subscribe to us depending on what platform you're on, whether that be podcast or YouTube. We've mentioned this before on all of our other podcasts. We offer 15% off of our coffee business that we have. So fresh coffee, 15% off to our podcast and YouTube listeners and viewers. That is podcast 15 over at caffeinate.co.uk, which is CAFFIN, the number 8.co.uk. We'd love you to check us out. Until next time, we'll see you around.
Cheers, guys.